Hello guys, my name is Mubashir and today we are going to analyze Lincoln 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 Pharmaceuticals Ltd. Is basically a pharmaceutical company which makes pharmaceutical products, medicines. So let's start with the technicals, then we are going to analyze the it is fundamentals. Let's go. Okay, looks like we have selected 1 month chart now. So basically the company has become public on Monday 2024. Recently launched its IPO, and it is quite looks like company is not doing well in terms of technicals. Uh, Soon it will be breaking. It is all-time low, that is around 5 500. We can say 500. It is a key support level and it is staying here. And now currently, as per the weekly chart, company is in consolidated. Okay, so now let's see as per the daily chart what's company doing. As I say already told you that it is in a consolidation mode. So as per the technicals, company is not doing well and it is currently at it is lowest price, we can say that. So now let's check out the it is fundamentals of Lincoln Pharmaceutical Ltd. Okay. Basically it is a small cap company incorporated in 1979. Products profile limited has developed 600 for formulations in 15 therapeutics areas and has 700 registered products with another 700 in the pipeline. It also have a 7 patent products and has file application for the 25 patents. Okay, that's good. Production facility, the company has a unit tablets. So let's go with the directly technicals. So basically company the stock has a P of 13 and the industry is 33. Return on capital employed is 17.6 and the return on equity is 13. So basically they have debts also. Let's see how much. Interest coverage ratio, debt to equity ratio is 0. That means the company is not having any debt at all. Okay, I was wrong here. Promoter holding is 49.8, which is increased by the 5.7 in 3 years. That's quite very good for the company. Interest coverage ratio is too much high also, as they don't have any interest obligation, as they don't have any debt. So EPS growth for the 5 years is 9.82. Okay, quick ratio is 3.97, means they may have more cash as compared to company have more current asset, which might include excess cash, and current ratio, which includes inventory, is 4.7. Means there is also an inventory which is company having. Book value is 335 and current price is around 535, means company is having price to book value of 1.6. That's quite good, where industry price to book value is 3.3 3.4 around. And debt to equity is sales growth for the 5 years is 10%. That's we can say average. APS growth for the 10 years is quite good. Average dividend payout is 4.12. Dividend is 0.34, which is not quite good. Basically, it is a small cap company. We cannot expect that much dividend payout. EBITDA is 8.47 less industry. We have to compare with the industry EBITDA. For that, PEG ratio is 2.1, which is high. Let's see. Overall, it is EPS. So basically, when the company was having around 232 price in December 17, company was December 17. Okay, it is December 17. Company was having a PE of 20 and EPS of 11.78. And the current market price of this company is 561, around 561, and PE is 13 and EPS is 41.111, which shows the company is undervalued as compared to its previous trends. So let's quickly compare with its peers. So basically, company comes at 8th position as in the healthcare by the market cap. So let's start with the quarterly sales variance. Comparing with the other companies, Lincoln Pharma having a high quarterly sales variance, increase of 18%. PEG ratio is quite average as compared to when we compare with the other peers. EPS for the 12 months is also good for this company. Sales variance for the 5 years is average as if we compare with the other peers. Slightly low, but we can say that it is average. Profit variance for the 5 years is quite low. Interest coverage ratio is quite high, as this company does not have any debt. Current market price to book value is quite low as compared to other companies. EBITDA is also low as compared to others peers. Current market price to sales is also good when we compare with its peers. And ROE and ROCE is also good. Overall, the company is undervalued when we compare with its peers. Let's check out why it is undervalued. Does it not making any sales and all? But we already observed that the company is having a high, one of the highest quarterly sales variance and 5 years sales variance. So basically, it is doing good sales, but let's see why the company's valuation is cheaper as compared to other companies. So basically, from 2022 March to 2025, that is during the duration of the 5 years, company's year-on-year sales growth has been quite positive. That's good sign. From 103 to 168, around 70%, we can say 65% growth within 5 years. 3 years. That's quite good. But let's see. Material cost look like company's efficiency towards the material cost has been reducing, and also employee cost has been reduced. Okay. Operating profit margin is quite fluctuating over the years, and it is we can say that it is stagnant. And depreciation is also stagnant. Profit before tax, profit after tax is quite not increased at all, because the main reason was behind that other income. It was a one-time expense, we can say that. Because of that, profit has been reduced. We can say that it was around 18 crore, and if we compare with this, it is already a 65% increase. And profit and loss account, the sales variance from the 2014 to 2025, around within the duration of around 11 years, sales has been increase from the 200 to 600, that is 3x. That's quite good. And expenses, material cost has been, the company has, as per the profit and loss account, over the years company has improved its efficiency towards the material cost. And manufacturing cost is quite fluctuating. It was increasing over the years, but it is now zero because of some reason. So overall it is was increasing. Employee cost has been also increased too much, from 8% to 18%, we can say that, around 2x. Operating profit margin has been increased, that's a very good sign. And depreciation obligation also increased because maybe company is doing capex on plant and machinery, buying more plant and machinery, which leads to the increase in the depreciation amount. So net profit in 2014 was 10 crore and now it is 84. That is around 8x as compared to the sales was 2 and 200 and in 2014, and now it is 600 around, which shows us 3x growth in the sales, and the profit growth is around 8 times. Now let's see the balance sheet. Equity capital, company has raised in 2017 also. Now it is not raising any money, and the reserves have been increasing over the years. That's a very good sign. And the long-term borrowing has been reduced to the zero. Short-term borrowing also reduced to the zero. Other liabilities, non-controlling interest also. Trade payables is slightly increasing. That's not a concern, that much concern. Fixed asset, let's see what's happening with the fixed asset. Land, company is as I said, company is purchasing fixed assets, land, building, plant and machinery, because of which it is the depreciation has been increased. Computer, which is a good sign for the company. Investment, company also made an investment throughout the years. That's a very good sign. Inventories are increasing. That's quite we can say, as per the growth of the company, the inventory is also increasing. That's not a matter of concern because of that. Trade receivables over the 6 months is quite low, and as under the 6 months is quite high. That's a very good things for the company. Company also having a doubtful debt, provision for the doubtful debts, and cash in cash equivalent. Company is also having a cash. That's a very good thing for the company. Cash from the operating activity, company cash from operating activity shows that the money which is generated by through the day-to-day operation of the company. Let's say if it is matching profit after tax after the adding back the depreciation, 100, 200 and 300, around 300 for the 2 years. Okay. Around 200, and after adding back, it is good, means company is actually doing sales on not doing sales on credit. Receivables have been decreasing over the years. Companies getting money from the debtors. Inventory is reducing, that's also good sign. Papers is reducing, it's also good as sign. Cash from investing in the companies, where company investing, let's see where the company is investing. Fixed asset purchase, already saw with that company is purchasing fixed asset. Investment purchase, that's also good. Let's see from where company is getting the money. Repayment of borrowing, as we know that the company is now a debt-free company. That's very good sign. Interest paid in the company, that's all. Overall, debtors days is reducing over the years. That's a very good sign. And inventory days is increasing, which is bad sign for the company. Means it is taking too much time to save the stock. Days payable is reducing, it should increase, but now it is reducing. That's not good sign. Cash conversion cycle shows that how much time does the company take to convert its receivables and inventory into the cash, and it is increasing over the years. That's a very bad sign for the company. Working capital days shows that how much for how many days the company's net working capital, that is current assets minus current liabilities, is stuck in the business. That's increasing over the year. That's very bad sign for the company. Let's understand what the promoters are thinking about the company, their confidence towards the company, their control towards the company. Promoters increasing their stakes over the years in the company. That's a very good sign. FIIs so also increasing their stakes over the years. That's also very uh, positive flag for the company. And BIS look like BII is not interested at all. And public shareholding also reduced in the company. That's look like public and BII is not interested in the company, but FIIs are too much interested in the company, and the promoters also have a confidence towards the company. Let's see the latest case rating for the company. Okay, so long-term fund base limits is 66. Okay, basically it has got A and A1 for the short term, for the long term interchangeable limit. Basically it is getting a good rating from the credit institution like ICRA. Let's see if there is any important news regarding the stock, like resignation resigned by the key persons to announcement under the regulation change in management, resignation of general manager in Engineering Limited. Okay, basically recently the general manager of engineering and maintenance has been resigned. There is no major previous recent news for this stock. Basically, as per my recommendation, first of all, I am not a CBD registered equity research analyst. I am just a normal guy who is just trying to learn. As if you want my suggestion, I would say that this stock is quite undervalued as compared to its peers, and it is doing very good in its industry. I would say we can hold this stock for the long term, and continuously checking this stock if it is doing good. Maybe it can give high return, and also it is at a very reasonable price as compared to the previous price at it. We can see that. So basically it is a undervalued stock. Thank you so much for watching. Have a nice day.